but we have complete access, independent access to the database. So that's factor number one. So we can read, thank you. Okay. Whoops. We can read everything that's in the database. We decide what are the key elements, the key tables, the key fields. Okay? So that's concept number one you got to keep in mind. It is an independent process. Number one is this: our approach is not a single silver bullet approach on doing an audit for continuous auditing. As the gentleman from Deloitte mentioned yesterday, you need to understand the industry. We primarily work in two major industries: finance and real estate. I wouldn't know what to do in manufacturing. Okay, so therefore I know my limitations, and our consulting expertise and our modules are conformed to those two areas. We have been approached to try to expand it, but basically we're happy in what we're doing in these two major areas. This process is not a detection process. I mean, it is a detection, it's not a preventive process. We don't prevent errors, we don't prevent fraud, we don't prevent, we detect materiality risks. And basically our approach is, as with any audit approach is, you try to determine where the risk areas are so you can focus your audit. It is not a monitoring process either. That's how we differ. And our whole approach is based on materiality. Now, what you hear a lot about is what is material. The standard is you usually have a materiality for the financial statement as a whole. Now, this is one of the shortcomings of the AICPA, because when they developed all these standards, they didn't know that technology was going to come in. So we now say we're going to develop financial statement area materialities. So we go from the total financial statement down to financial statement areas. Now, the materiality issue is not defined, unless somebody wants to correct me, in the literature, the standards. They just keep on talking about the financial statement. As long as, according to the present guidelines, as long as you don't exceed the financial statement materiality, you can work in that threshold, and that's what we do. What was mentioned earlier yesterday about a point in time. Our process is not, we don't come in to audit at December 31st. Our process starts all during the year because we're auditing transactions for the full year that culminate in a financial statement. So therefore, we're in there during the year. Now, let me just do two more. We have approximately 400. Anybody know what functioning programming is? It was developed by MIT. It's based in Lisp. It has a whole bunch of functions, modules that you can interchange. That's what we effectively have. We have over 400 modules that come in that yellow area, so that once we do all of this process, the sequential tracking, we get to that particular area. We then say to look at what we're looking at, and we pull our modules together so that we're not the client is not conforming to our technology. Our technology effectively is conforming to what the objective is. All of our reports are fully transparent, meaning the results are fully transparent. And one of the major achievements we have done is what we call in auditing dual testing, which is required by the PCAOB, by the way. When 5 originally came out, the biggest complaint was everybody was running around, send the IT guys in to test internal control, then send the auditors in to do the audit, and your fees are astronomical. What we've been able to develop and been checked and verified on is we can do dual testing. So that's the platform for what we are and what we are not. And I am going to now briefly describe to you risk-based SAP. SAP means Substantive Analytical Procedure, which is a process that is encouraged now both by the AICPA and the PCAOB, which means instead of doing paper shuffling and verifying, do high-level analytics to satisfy the audit process. That just played into our rule book, because back in the early 90s, when I used to expound upon that, the constant response I got was, that's not auditing, that's not accepted. But AICPA now and the PCAOB have moved on. They call them CATs now. And effectively, that's what we do. This process, again, so now we start off and we say, basically, we bifurcate all the financial transactions through debits and credits. Why do we break out the debits and credits? Because we look for what we call within the system control units. We don't look at an account and see what the charge is. We work our way up to what the control of that debit is, because it affects another account. Remember, the Italians, who I am, developed a double entry system. So for every debit, there's going to be a credit. So therefore, we bifurcate. When we go in and we take, for instance, we look at what the cash is the transactions are. We say from source of cash all the way to the financial statement that says cash, we're going to work that process so that we can satisfy ourselves that the cash balance is what it is, and we verified it. And so we bifurcate that. And in that process, we determine the highest correlated sequence. Now, in my area, I'm not manufacturing. I usually work in finance, which is credit cards and so forth, or in real estate. And those are the three areas that we bifurcate. So sequentially, it is either a daily process. Retail sales would be somebody I'm familiar with who's using the process weekly, or real estate is monthly. Why do we bifurcate in that particular area? Because one of our main processes is to look for correlations. We are examining for risk areas. And if we have something that has a sequential process, it's easy for us to detect risk. Establish comparative reporting periods, which is traditional. You take, there is a process in auditing called audit expectations. This works very well in determining audit expectations based on correlations, based on, we even have various processes, probability models that do this, that comes up with the comparative reporting. And then the key area is establishing audit risk platforms, which again comes into, there's not one. What's the goal we're seeking? What's the financial statement area? For instance, when we seek out in cash, it could be completely different than we're looking for whether or not we have impairments in real estate, or whether or not the leases effectively are been approved. There are different objectives based on the financial statement area, so therefore we pull the modules together for that area. Keep that in mind. We have therefore worked on stationary modeling, non-stationary modeling. Part of our module has to do with financial volatility. There is a whole school of volatility in the stock market, as you all know. You got the Markowitz, you have efficient calculations in which, based on how volatile something is, you basically can make a judgment as to whether or not there is a risk. We take volatility, we take materiality, we take basically industry approach, as it was mentioned earlier yesterday. Where is the industry going? For instance, today's environment. If you did what is traditionally called a static pool calculation to make a determination as to whether or not your reserves, for instance, on receivables are okay, and you do not take into consideration the market today is in the tank, you're in trouble. Yet the accounting literature will tell you that taking the static pool historically is acceptable. But it's been already determined by major lawsuits and by PCAOB that you can't just stop there. We don't stop there. In all our modules, we take this all into consideration. Maximum identification, maximum exposure to loss.